let's solve this question. So again, pause the video and read the question first, and we'll get started together. So let's get started. Now, before solving anything, I will literally copy the format that we already learned about the make or buy decision. So let's copy this and we will paste it here. There we go. Okay. So in the question, obviously we have a choice. Either we can make the part X. Let me zoom in for you. Either we can make the part X ourselves, right? Or we can buy the part X from an external supplier at 12 per unit. So uh, we know a couple of facts here, like what we're talking about. And if you notice, 60% of the fixed overhead is said to be unavoidable. That means the remaining 40% has to be avoidable, right? So that's the logic. If 60% is unavoidable, that means the remaining has to be avoidable. And then the space used to produce part X can rent it out for $8,000 per year. So now that is where the opportunity cost comes into play. So let me explain. So they are telling us in the question that if we decide to keep making the part X, we'll have to spend this much money, material, labor, variable overhead, and fixed overhead. This is per unit, so I'll show you how to convert it into total. And also, uh, we will lose out on renting out this space for $8,000 per year. Because think about it. If I keep making the product in house, I will need that space to keep making the product. So that means this $8,000 has to be considered as opportunity cost. So this gives me an opportunity as well to add another thing to the format, which is, sorry, there we go, which is opportunity cost. Because we said opportunity cost is always relevant if there's any in the question. So opportunity cost, it will go in the make area, because usually in the make or buy decision, if you decide to keep making the product, you lose out on the extra money you can make by renting out that place to someone else. You know what I mean? So in this case, we will add that here as well in our format. We'll say opportunity cost in the make column. Now, obviously, I could have made the question a bit easier, but why don't we just solve the maximum question you encounter, like with the opportunity cost and everything. So let me show you how this format really works. So first of all, I need to write down the direct material I'm using for the product. So if you notice, we are using 5 per unit. And how many units are we supposed to make? 10,000. So 5 times 10,000 will be, so every year, I'm going to be spending $50,000 on material. Similar with labor, 4.50 times 10,000. Similar with variable overhead, 2 times 10,000. And similar with the fixed overhead, but again, we know only 40% is avoidable, since the question is saying 60% is unavoidable. So what I'll do is I will grab the 40% of per unit number, which is 3.5. And just to let you know, per unit is not actually like per unit, because fixed costs are not dependent on the units. What has happened is uh, the company has actually divided the total fixed cost by the number of units. That's how they know the per unit. We don't actually spend fixed cost per unit. So with that being said, first let's convert the per unit into 40% and then multiply it by the number of units we are supposed to get it for. And then the opportunity cost, if I keep making the product, of course, if I keep making the product, I will lose out on this space being rented out to someone else for $8,000 per year. So I'm losing out on that rent money that I'm going to make if I didn't make the product and gave the space to someone else to use. There you go. And the purchase price is always just the purchase price usually. So we will have to pay 12 per unit. And how many we need to buy? 10,000. So let's see which is cheaper. So in this case, okay, so it's cheaper to buy the component from uh, an external supplier. So we will say the company should buy the component from the external supplier. And if you notice, if we buy the component from an external supplier, we are saving out on how much money? $17,000. That's called a financial advantage. Okay. So in making this decision, if from buying it from external supplier, the financial advantage would be $17,000, and that's it.